Hello, fellow investors. AIM's APAC REIT full year 23 results show that it's firing on all fronts. So, subscribers for this channel should know that I'm pretty big fan of this REIT. In fact, I bought a whole chunk of it in late last year, and the results are paying out. In the last video on the REIT half a year ago, my title was that fortune favors the brave. Of course, this was the period where the share price was really depressed, went to as low as 116, where I bought a whole chunk of it. Of course, if you had bought it then, you'd be staring at very, very good returns. This is the 5-year chart of the REIT, and you can see this is a low, right, in 2022, when the morons were selling everything all the way from 1.3 plus all the way to 1.16. So if you buy everything here, you'll be looking at 20 plus return, 20 plus percent returns in less than 6 months. Fantastic. Actually, if you look at the 5-year charts, right, this was what was happening pre-COVID, and it was already in a gradual uptrend. Very well managed REIT, and the fundamentals are showing. Of course, this was panic selling during the COVID period, which was understandable because there's so much uncertainty. And after that, you can see that the share price actually rallied big time to almost 1.6. Of course, then Jerome Powell had to do all this moronic stuff like ignore inflation, and now starting to hike rates 5% in 1 year. The Fed is just a bunch of clowns. Of course, the REITs of course then tumbled. But if you look at the what's happening in the fundamentals, I think the uptrend is gonna resume again. And if the Fed does a U-turn subsequently in early 24 or maybe mid 24 or whatever, and starts cutting rates by a couple of percentage points, I think this stuff is just gonna rocket all the way up, breaking 1.6 subsequently. Of course, rate path decisions by the Fed will be very, very crucial. But I see that the REIT is trying to break 1.4, and if it breaks 1.4, resistance will turn into support, forming into a decent support for the REIT. And I think if it breaks 1.4, next stop 1.6, maybe after that 1.8. Who knows? This is of course the most important thing that matters. DPU is the DPU that matters, mate. Not distributable income, not your AUM, not revenue, not top line. It's the DPU that matters. And you can see the REIT really performs. 5.7% in 22 increment, now 5.1%. So over the next over the past 2 years, this stuff has raised DPU by 10%. Of course, this is just mathematical, because logistics property are doing very well. And in 2021, they have signed and FY20, they have signed rents that are rock bottom, right, because of the COVID uncertainties. And now that things are recovering and there's a strong demand, of course, things are going to recover, right? So it's just plain math, Just think about it and you know it's going to recover. It's brainless. So these are the 23 key highlights. I think it's quite cool. DPU is here. NPI yield based on current price is 7.5%. But if you bought it in late 2022 at 1.16 and 1.2 and so on and so forth, you're looking at the DPU use of more than 9%. Fantastic yield on cost. And the rest of the stuff is quite evident. The weighted average land lease expiry is quite impressive. 54 years. That's because they've bought a bunch of stuff in Australia. Long leases, freehold. So that helps to mitigate the lease decay in Singapore assets. And you can see the average gearing goes down from 37.5 to 36%. So that indicates that the valuations have actually popped up, which is very good. In this environment where we're talking about rising interest rates and rising cap rates, you still have rising valuations for this guy. Look at the other guys, man. Everything is just going bananas. Rising rates, therefore rising cap rates, asset valuation that declines, busting their gearing ratios. Now they have to look for strategic options to sell assets, sell managers, sell whatever nonsense. Well managed REIT. That's fantastic. This is the that's just one point that I want to highlight, which is the fixed rate debt as a percentage of total debt. It says it's 88%, but actually it's quite nice for them to clarify. I think this is the first time that they're clarifying. I'm not very sure. That actually 71% is on fixed, 17% is on forward IR assets. So I think the impact of rate hikes should have some impacts on this guy going forward. But nonetheless, 71% is still on fixed. I'm not sure when the forward IR assets will start kicking in. But when it kicks in, the fixed rate actual would be more properly shown. The NAV goes down from 138 to 137, but this is nothing because if you look at the valuation declines for the other REITs with overseas assets in Australia, UK, EU, everything is just declining like mad. So for this guy, actually the NAV decline is just marginal, fully acceptable, I think. Debt management fund, also nothing much to worry about. For the full year 24, which is for the entire next year, there's no refi needed. So refi will come in FY25. So that's like 1.5 years away. So in the meantime, sit back and relax. The valuations was quite interesting. Singapore assets rose due to reversions and the AIs done at the 23 Tai Seng, which is now leased out to a data center guy, which is quite interesting. Australia, the valuations decline. Actually, it's not just FX. Cap rates are also higher. So if you have REITs with overseas assets in Australia, I think you better watch out because the cap rates are rising quite fast, I think. So this is probably the most important slide in the entire presentation, in my opinion, of course. So look at it. In the full year 23, the rental reversion was 18.5%, which is very, very high, right? But in 4Q, it was 37%. Oh, which is amazing, right? When was the last time you heard of rental reversions of 37% in one quarter? Even more significantly, the renewals was not just one or two small spaces, right? It's 20% of the NLA, and they managed to get 18.5% for all this space in 1 year, which is very, 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 very difficult to do. So that shows you the underlying demand and how under rented their assets are. And what's even better is that they gave some guidance in the next year. 19.4% by GRI will expire, and the passing rent is 122. Market rent is 1.4 to 1.8. So, well, if things carry on what they are now, and things don't go into a crazy depression, you're looking at very, very healthy pickups of reversions of the rent of a very, very high expiring lease profile. So if 19.4% gets renewed at such high rental reversions, that's going to trickle down all the way to the DPU. So, well, looking very, very good instead for this guy, actually. If you look at the Ascendance REIT's results, actually it's the same picture. So I don't think it's just idiosyncratic to this guy. It's the entire demand for logistics assets. I'm not sure how long this will continue, but while the sun is shining, let's go to the beach and suntan, man. Don't wait for the rainy days to come and then you start staring at it. I thought the asset management was quite interesting. They did the AI at Tai Seng, which is fast turning out to be an interesting area. If you look at what's happening in the area, and then they leased it out to this data center operator for 7 years. Also, some conversion of MTBs to master lease. More importantly, look at the NLA increment, right? For Tai Seng, NLA increases of 32%. This guy is going to be increasing by 17%. So that's fantastic, right? Just growing inorganically, increasing the NLA, and then increasing the rent. So it's a double positive, right? You increase the amount of space you have, and then for each inch of space you have, you charge higher for it. So that's fantastic. And then they divide this stuff at the premium to book. They're probably gonna recycle the capital to do AIs or whatever. Let's see what happens. But these guys are good at capital management, so I wouldn't worry too much about it. I thought the new tenants added for the year was quite interesting. Lee and Fong is in. And Lee and Fong is of course this big guy in logistics, right? Also quite interesting were the motor guys. Mitsubishi is here. Jardine is here. CNC is here. So it's quite interesting. These are the motor vehicles segment, right? I wonder if there's gonna be EV related stuff for these guys. Maybe because you see that Hyundai is setting up their EVs, Dyson is setting up battery plants in Tuas. So I think this EV thing might be a new thing for Singapore. We have to watch out. Maybe this is a new source of demand for logistics. Overall, well, same thing. In Singapore, long-term demand is high. Rental growth is gonna sustain. Modern and high specs developments have rental growth, attractive, and most importantly, they say that it's still positive yield spreads. So they might be able to do some capital recycling from the sale of Yishun and buy some stuff in Singapore with accretively, which I welcome actually. If you do a little placement over here at the current book level and do an acquisition which is accretive, I think I'll welcome it actually. Same thing for Australia. With the cap rates rising, they might have some repricing and therefore good buying opportunities. This is also quite good because it will extend their land expiry profile. Most importantly, these guys have been good in capital deployment, and I'm quite supportive of them doing placements at these levels. So for me, my idea for this guy and my plan, just hold on dear life, right? Hold on dear life for the next 2 years, wait for the rental reversions to kick in and markets to re-rate this guy. Actually, in Singapore, the main attraction of REITs is not really in the blue chip names at this level. It's in the second tier names that have very little analyst coverage. Nobody really cares about them. With a very well managed capital management, very strong balance sheets and attractive assets. These are the gems in the estate space that people should be looking at and looking to buy in a crisis.